Good morning. This is Yimin. Welcome to YX Insights. Today, we're going to do our usual market analysis covering equities, bonds, oil, Bitcoin, Max 7s, gold, and semis. So we are going to get started straight away. Looking at last week's non-farm payroll numbers, we had a little bit of a disaster because not only was last Friday's figure, below the expectation, the previous 2 months non-farm payrolls also got revised down by almost 90%. So unemployment rate at 4.2% now. The market got into a bit of a panic on Friday last week. However, the market has calmed down a little bit now and is now has recovered a lot of that Friday's fall. Looking at the FOMC projections, we're looking at a slam dunk 25 basis point cut in September, as well as very likely cuts in November and December, due to the market reaction to the weaknesses in the non-farm payrolls data. And then we're looking at 4 to 5 rate cuts in the next 12 months. So is this too aggressive? The Fed is famous for its data dependency. So they are eager to see more data over the next couple of months into the September FOMC to confirm whether the labor market has really started deteriorating and the employment rate is going to continue to move up, as well as the inflation data, whether it's starting to move down or is going to stay persistently at a above target level. So taking those factors in mind, whilst September is a likely cut, I'm not really sure about the consecutive cuts in November and December. So now looking at the year-to-date performance in cross assets, we have SPY up 8% and the QQQ up 11%. This is above average returns by this time of the year. And in all the years that have done better than this year, we have seen double-digit returns in SP 500 in the past 30 years. So last week, I wrote that we are still looking very promising for double-digit returns for the year end. I still believe that should be the case. But of course, volatility means that we will see a lot of ups and downs in between now and the year end, especially in the second half of August and the entire September. We tend to see a lot of seasonality weaknesses, as we'll see in a second. Gold has been sideways for past 4 months, but still up 29% year to date, best performing asset. And Bitcoin closely behind, 26% year to date. And what we have seen is that gold tended to move first, and then Bitcoin follows a couple of months later. Also looking at cross-asset correlations, where we observe that TLT is very negatively correlated with Bitcoin, and as well as small caps, IWM Russell 2000. What this suggests to me is that when bond prices go down, i.e. yields go up, risk assets go up. So small caps, Bitcoin, they're moving up. So these risk assets moving in the same direction as the yields. And that sounds counterintuitive because what we understand from theory is that high yield puts pressure on low dividend yielding or low cash flow yielding assets, because of the discount rate gets higher and opportunity cost gets higher. But what we see in practice is that weak economic news is taken as bad news. So bad non-farm payrolls data means yields go lower because people were expecting Fed to cut, and the recessionary odds also rise, and people get into a risk-off sentiment and they sell down risk assets and they buy bonds. And the reverse is also true. When people feeling a bit more bullish, they're switching out of bonds, yields go higher, and they're putting that money into risk assets like Bitcoin, IWM. And I would say SPY/QQ at 0.2 correlation is fairly neutral, same as gold. So that's a general observation for now. That regime might change going forward, but we are looking at those things on a weekly basis to see what's happening in the near term. And this correlation between the rotation into bonds out of risk assets and vice versa is holding right now. Finally, we're looking at SPY seasonality. Marginally bullish in the next 10 days, but going into end of October, second half of October, as well as generally September, we're in a very volatile up and down period. And towards the end of September, we should get really cautious, especially after the September FOMC. And if the Fed start cutting, market might take that as signal as the Fed acknowledging recessionary risk, labor market risk, and that therefore it could drive risk-off sentiment, which coincides with seasonalities. For SPY, what I'm really focusing on is are two factors. First, we are still below this high from last Thursday. So as long as this high is still here, we're not 100% out of the woods for a deeper pullback for this wave 4. But the good thing is we do have a very strong supporting trend line since May. That's been tested 3 times, it's held. So it could break this time, but that is a near-term support also with substantial volume profile here. So a lot of people, investors are interested in buying at this 220 region that is supportive for the price. If we break below this trend line, and actually even worse, if we get below this Friday low, we are looking at a 580 to 600 region as the next sort of pullback zone. There's a bit of a volume vacuum in this of 605, 600 to 620 level. So the price could drop quite quickly into this box. Now, do I think it will go all the way to 200-day moving average? Just looking at how fast dips are getting bought, I think is quite unlikely we test this 200-day moving average straight away. And even over here, there's substantial volume profile where investors are very much interested in supporting this region. So overall, I don't think we're very unlikely to break this 200-day moving average. And I think the chances are we're not even going to test this region. We're going to test maybe the upper bound of this box here for a minimum wave 4 pullback. And I do think we're going to see higher highs in wave 5, even if this pullback happens. And QQQ, very similar. We have a supporting trend line from May that's been tested 3 times and held. So falling below this and the Friday low, we have the 50-day moving average, but over here, there is a bit of a vacuum in prices. So a lot of investors might wait all the way down to the 515 to 535 regions before they start buying the dip. And we have the 200-day moving average, and with a lot of volume being supportive around this region. So I don't think we will get a really steep wave 4 below this 200-day moving average. And I think the chances are we're going to test maybe this upper boundary or even the upper half of this box for the proper wave 4 pullback. As long as we stay above this trend line, and actually if we clear a new autumn high, we might not even have started wave 4. We could have just have a much more extended wave 3. So for now, the trend is still very bullish in the short term. I'm not overly concerned until we break below the support region here. Looking at oil is a difficult one to decipher. So I have been expecting a higher high in this wave 5, but we only got some of it in July and before we're testing the 200-day moving average. Overall, as long as this wave 4 holds, I'm still optimistic with a bullish bias. And the thing is, with oil, if you just zoom out a little bit, it's been largely sideways action for the past 3 years. It is a very wide sideways for sure, between 60 and 85. And actually, perhaps you could just do away with all this early wave theory technicals and just take on a very simple strategy of selling the highs near above the 80 and buying the lows around the 60 region. That would have done pretty well in the past 3 years. So until we see a sustained breakout either way, it's pretty much a neutral asset for now. Now, also looking at the 30-year yield, we got some pullback in the past couple of weeks, but the near term price action still suggests that we're in an upward trend with higher highs and higher lows here. So unless we really break below this channel, my view is still biased towards further upside in the 30-year yield in the medium term, and we could test mid 5% for this smaller degree wave 3. And just looking at yields since the end of 2023, it's just been a very volatile, wide-ranging sideways action between 3.8% and 5.2%. So again, this is not that easy for directional trending, and one wouldn't be faulted if they just try to trade the ranges until a breakout. And for TLT, my medium-term bias is still towards the downside, but again, we have been largely in a very much sideways action since the second half of 2022. And it's recently broken above the 200-day moving average. So on the market in the near term, that is a bit more bullish. Our model has also been a bit more risk on in the past week. So I think there is a chance we test this upper bound of the channel. And my primary expectation, looking at the technicals, is that it should get rejected. And also in terms of the fundamentals, with the one big beautiful bill passing and bigger fiscal expansion, the longer term yields are biased to move higher, and bond prices risk falling lower due to a supply risk, but also if the Fed is cutting rates in the near term, there is also higher inflation risk in the long term. So in the combination of those things, I am biased in the medium term for bonds to move into a lower low here, but breaking above this trend line and obviously above the April high would invalidate that view, and I have to really relook at the technicals again. The US Treasury has been issuing more short-term bills and notes to reduce the pressure on longer end yields. So I could see that argument play out, that they just keep on doing this indefinitely, switching duration into the short end, and to keep the longer end yield in check until GDP growth picks up substantially. Then the budget deficit to GDP ratio would also actually come down just by the virtue of GDP going up. So that could work, and I think the implementation is difficult. So in the near term, I'm more or less following the price technicals for now. Looking at Bitcoin, Bitcoin has likely completed its wave 4. This wave 4 was quite steep. It was the 0.618 retrace of this wave 3, but it's above wave 1, and also the wave 2 was pretty shallow. So the alternating principle allows for deeper wave 4 in this scenario, and it has recovered back to the region that was seen in the second half of July. So I do think in the near term, we're poised to move higher into this wave 5 region at 126K above. And I do think that is a near-term timeline. Whether it could get extended, I don't want to front run this too much. We will have to see once we get to this initial target. It could run a bit further to 130K, 135K, and we will go from there. But I remain bullish. We still see strong, consistent institutional flows since July, and a lot of the leveraged loans have been knocked out in this fall at the end of the month. Also looking at Bitcoin versus the G5 M2 money supply, pretty strong relationship in the same direction. The M2 money supply has been expanding thanks to both the actual money supply expanding, but also a weaker dollar. And I don't see Bitcoin having topped already based on this relationship either. So I do think Bitcoin will continue to move up. And once we get to September, we could get a period of weakness and volatility. But for now, I see the near term to be quite positive for Bitcoin. Looking at gold, GLD is slightly boring investors to sleep. It's been in a sideways action since April. We've seen the gold price is moving range bound, GLD trading at 290 versus 320 for the past 4 months. So now, if GLD breaks above this channel, it's tested 4 times. If the 5th time is lucky, we could get this red bullish path towards wave 5 with a target of 350 ultimately. So about 10-15% on the upside. And of course, if it breaks below, we could be testing this 200-day moving average, and this will be a flat structure for wave 4. So a flat is when wave B is very close to the beginning period, and then we get A, B, C 3 waves to complete this wave 4 move. I've been watching this for a while now. I am switching to a slightly more bullish view, just based on the fact we're seeing higher lows now and gold being bought up, especially when equities look weak. So we could see a gold breakout next if we get a substantial pullback in stocks. Apple has pretty much been going sideways since the initial liftoff in April, and it's been trading between this lower support just under 200 and the upper bound at 15. So our risk signal, the machine learning signal, actually switched to risk off on the 5th. Because of the poor technicals, as we saw here, as well as the general weaknesses in the indices. So early in the week, actually, our machine model didn't like Apple very much at all. But the announcement with the White House that Apple will invest $100 billion in addition to the previous $500 billion plan onshore in the US, saw a 5% jump in Apple's price, which is more than 2 standard deviations. So pretty unusual event. And then we got the follow-through 3% rise yesterday. So actually, after this resurrection of the stock price, our machine learning model is back to risk on. So now it's sitting just under the 200-day moving average. I do think this will be quite a tough area to get through because of the heavy volume profile here. People could be thinking of unloading at break even, those who bought earlier in the year. So I think getting through here is going to be quite challenging, but if it does manage to get above 230 is very constructive for this overall wave 3. So getting over here gives me the confidence that Apple will head towards 260 plus after. Amazon, very similarly, machine learning model went to risk off for 1 day after the fifth because of the poor technicals after the earnings, as well as the overall market weakness. But Amazon bounced 4% on Wednesday. Machine learning model really likes it. Now back to risk on. Follow through yesterday on a small gain, and we're looking very likely for the scalp fill and then a wave 5 high near the 250s region. So near term, I'm pretty bullish for Amazon. For Google, this run is not too extended. I think this wave C equates to around wave A, but there is room for this wave C to extend slightly further to the 1.2 extension of wave A. And overall, the wave 3 is not too extended either. But below this high, so Google has struggled to get past this 198 level. As long as we stay below this high, there's always the risk that we have just begun the wave 4. If we have begun wave 4, then the target range will be 176 to 185, which is the 0.236 to 0.382 retrace of this entire wave 3. And of course, you have the 50-day average and the 200-day average, as well as heavy volume profile beneath the 176 region for heavy support. So I don't think Google will go substantially lower than 166. And I do think that this region is quite a good region for initiating a new buy and targeting at 200 plus wave 5 region. Meta. So we completed wave 4 just before earnings, and we I think straight away completed the wave 5 of this wave 3 right after earnings. So Meta is still staying below this post-earnings high, although very close to it. If the broader, larger degree wave 4 has begun, then we're looking at 676 to 716 as the initial target region for this wave 4 pullback. Lows of volume profile around this area, and the 50-day moving average as the initial support. Could it fall much below? There's a chance it can get to 650 just because this wave 2 was very shallow. So this wave 4 alternating principle dictates wave 4 could be a bit steeper. So my initial target would be the 676 as the supporting region, but following that, we could test the 200-day moving average. Microsoft, the price is still below the post-earning high, and I do think from here, this is the first set of earnings. We had the Q1 earnings jumping higher, and then we had last set of earnings marking as the top. So all of this is very obviously big money buying. What you can see is that people are chasing the stock, so a gap up didn't look down, and people are buying portionally every single day into the second set of earnings. So this is very obviously managed by big money. The volatility is very low each day. It doesn't rise or fall more than 1.5%. But we are seeing a bit more weakness since this earnings pop more recently. And I do think we have a chance to first challenge the 50-day moving average around 500, and then also getting around this 470 region for a slightly deeper pullback. So 470, 500, I do think is a potential buy the dip region for this wave 5 higher. Ultimately, that could be a long-term top for Microsoft as well. NVDA, it's hard to say that wave 4 has definitively begun. We're still pretty much trading at the wave 3 highs here. It could further extend. If it does extend, it is getting quite stretched for this wave 3 relative to wave 1. So I don't think the risk reward is that great. And also after this run, the valuation isn't that attractive either on a growth adjusted basis. So my primary expectation is for a retrace towards the 140 to 150 region as the first stop. We get a lot of volume just below the 145 area. So I think it's quite difficult for NVIDIA to fall below the 200-day moving average just because of how much interest investors have shown in this region. So I do think the 140 is probably a decent opportunity to get back in for the final wave 5. Tesla has been really testing investor patience. It actually got off a pretty good start in May, leading the rest of the market. But since the fallout between Elon and Trump, and Elon wanting to start a new party, we have seen the prices moving sideways. First in a more volatile manner, but now actually the range has become much smaller, so it's coiling into a bullish triangle here. I do expect the price to break out at some point in the near term and heading towards this wave 3 high near the 420 plus region. And I think there's a quite good chance that for the entire run to finish at where the September high was, which is the 480 region. For semiconductor, it has tested the 50-day moving average, and it's been supported so far in this price region. But it does look like wave 4 has begun, and I could see a deeper pullback in the 210 region, which is the 6-day moving average, and the 224 region, where there is actually a lot of volume here. So I think the deeper correction will come when NVDA takes the lead in its own wave 4 pullback, and the AMD also has recently corrected after the earnings. So I think overall market should get a bit more consolidation in the near term. Finally, Palantir, it has been on a relentless wave 3 run, which we have been expecting for a while. I think now we're getting into a more stretched territory at the 1.76 extension of this wave 1. So I do expect a pullback to occur soon. It could carry on to 200, but the risk reward is just in there. And if it does pull back, we can test the 50-day moving average around 140 to 150 region before seeing one more high to round off this wave 5 of 5. So that's it. Thank you for this week. We'll speak soon.